We often come across regular P&Ls on a day-to-day basis. As a CFO, when I go visit a company, they will have their usual P&L that they will give to the auditor and that they also use for internal purposes. So the usual P&L, the typical P&L that we use has the revenue, the COGS, then after the gross margin, you subtract the COGS, then you take out the SG&A, then you come to your final profit margin, etc. Right? So this is great from a tax auditing purpose, etc. Right? But as a CFO, it doesn't help me to make better decisions. Right? So every firm has to have an internal view of the P&L for multiple reasons. So the first thing is to understand the contribution margin, right? The cost of a particular item to be produced has two components. One is the direct cost or the variable cost of that particular product or service that we are offering. Then there are other costs that is not directly tied to the production or delivering of a product or service. So when we price a product or a service, we need to ensure that the direct cost, the direct variable cost is the bare minimum that is covered. And then anything beyond that, the price or revenue we get from selling a product or service goes to covering our fixed cost or our step cost, and this is called as the contribution margin. So let's assume, theoretically, that a product is priced at 100 rupees and our direct variable cost is 80 rupees, right? Then we have 20 rupees that can be called as contribution margin that will be used to pay off some of the fixed costs, like our overhead costs, such as the rental cost or the senior management or the selling team's cost, the marketing team cost. So these are costs that are not directly related to delivering the service or creating the product. So when we are pricing a product, we often will include all these costs and say we have to make a profit after selling that product. But a lot of times we have to be more tactful than that. There are some times where we break into a new geography or we are trying to acquire a new customer, in which case just covering the variable cost will suffice. So I'm going to talk about this in a little bit of detail now. So at MFA, different companies are treated differently to do this analysis. But let's look at an example of a manufacturing firm, a standard manufacturing firm that's in the traditional manufacturing industry, and how we want to think about the various cost components. So let's see the first piece of the cost. So let's assume they have a factory and there's some raw material that they are procuring. Let's say they are making garments or bicycle, whatever it might be. They will have to buy the raw material, the parts, the steel to make the bicycle, right? So that is direct material. And then there are workers in the factory assembling these components together, making that bicycle directly. So this is the labor that is directly involved in producing the final product. So that's direct labor cost. So if I am not producing that bicycle, I don't need to spend on that raw material. I don't need this worker there in the factory. There might also be some additional smaller miscellaneous expenses. Let's call it DO, other direct expenses. It could be a lubricant, whatever, to run the factory. Maybe that product or the material doesn't go directly into creation of the bicycle, but because we are creating a new bicycle, we are incurring that expense. So when we add all this up, direct material, direct labor, and the direct other expense, DE or DO, let's call it DO itself. So this becomes prime cost. So DM plus DL plus DO is called as the prime cost. This is the first cost. We have to ensure that our pricing at least takes care of this prime cost. Otherwise, we will be losing money the more we produce a product. So for our example, let's take the case of a bicycle and the direct material, direct labor, direct other expenses together. Let's assume it comes to 2,000 rupees. So I've taken some rough numbers here for the bicycle example. 1,000 rupees for the direct material, 900 rupees for the direct labor, the workers working. This is per unit, that is per bicycle, right? So every time I have to produce a bicycle, this is what happens. And so let's assume it is 2,000 as the prime cost. So my pricing can never be below the prime cost. Prime cost is the basic with direct variable cost. Okay. So now let's come and look at the other costs in the factory itself. So there will be other costs in the factory. Even if I don't produce a single bicycle, that's going to be space. Maybe we are paying rent, or there is some utilization of electricity, whatever it might be, there will be a security person. So all of those, right, are called as factory overheads. Just like the direct, there might be some material, labor, and other expenses here. So let's call it the factory overheads. So together, per piece of the cost of the factory overhead and the per piece prime cost together gives you the production cost. In 99% of the scenarios, we want to ensure that we recover this cost when we sell the product, right? So that way we are covering the overhead of the factory and the variable cost of the factory. So at least the production cost is covered, right? So anything beyond that, right? Anything beyond that will go to cover some of the financing cost. If you have taken on some working capital, loans, any other debt, we need to pay back the interest to service that debt. So production cost plus financing cost together at MFA, we typically look at this. We call it as the PIF cost. So this is the third cost. So why I'm saying this is first cost, second cost, third cost? Because all of this ties into the product pricing strategy. Sometimes we will want to cover all of these costs, including what we're going to look at, the SG&A. Sometimes we will only cover the PIF cost. Sometimes we will cover the production cost. But if we are covering the production cost and there is a little bit more left, that incremental revenue or the leftover revenue is contributing to reducing the financing cost. If I am able to cover the PIF cost completely and there is anything left over, then it will start to cover the cost of the selling team, the marketing team, the management team, the SG&A, right? So that is going to be the contribution margin to cover my SG&A cost. So including SG&A per piece and the PIF per piece, we get the total cost per piece. Anytime we can sell over and above the total cost, we obviously will make a net profit per piece over and above the total cost. But the whole point is sometimes we might not be able to do that. Sometimes we will not be able to price more than the total cost. In those scenarios, as a management team, as a CFO, we take a call at where to come in. It might be sometimes between 2 and 3, sometimes between 3 and 4, or sometimes even just a little more than 1. All right. So if you have any questions on this, leave a comment or give me a call. I'll be happy to help you with this.